Hello, welcome to today's CIM MES discussion group presentation, part of our Perspectives and Insights on Metals and Mines series. And we've got a wonderful speaker today, Jeffrey Christian, Managing Partner from CPM Group. And his presentation is entitled Gold and Precious Metals 2024 and Beyond. My name is Carlos Da Costa, Chair of CIM MES, and this event is being sponsored by IM Gold Corporation. For those of you who don't know who CIM is, or even who CIM MES is, a little few words about us. Okay, so CIM stands for the Canadian Institute of Mining, Mineralogy, Petroleum Association. We are a leading nonprofit technical society of professionals in the Canadian minerals, metals, materials, and energy industries, with 11 technical societies and more than 30 local branches across Canada and overseas. MES stands for Management Economic Society, and we are a society within CIM, and we've primarily focused on education in the context of mineral economics. So without further ado, I'll let Jeffrey take over. Thank you.
So I was asked to talk about gold, silver, platinum, palladium, all four metals, and to talk about what's happened in 2023 and what our expectations at CPM Group are for 2024 and beyond. So I have about 29 slides. I'll try to go relatively quickly because I really revel in the Q&A and want to address your issues. Starting with gold. This is the long-term gold price. And what you can see is that in 2020, we had a record gold price. And then in 2021, we had a record gold price, which was about $1,799 on average. In 2022, we had a new record annual average price of $1,804. This year, we will have a new record annual average price, which will probably be around $1,950, depending on what happens in the next 3 weeks. By the way, happy St. Nicholas Day. Next year, we expect a new record price of gold, and we expect it to be north of $2,000. So another significant increase. It sounds big, more than $2,000 on an annual average basis, but it's at actually probably about a 6 or a 7% increase year over year, because the price already has risen very sharply from its, it had formed a base from 2013 to 2019 between 1,200 and 1,350. It broke out of that range in the middle of 2019 and has not looked back. Our expectation is that if the average price next year is $2,040, the range of prices could be anywhere from $1,940 to a much higher level. We in a spike, you could see $2,400, $2,500. If you go back to 1980, the average price was a record $612, which was more than double, probably triple the previous record annual average price. But the intraday high was $850. It was only there for a couple minutes. In 2011, the intraday high was 1,998, I think, and the average price was about $1,650 or $1,670. If you look at what happened Monday trading in Asia, Sunday night here in the East Coast, you saw the gold price go from $1,290 to $2,152, about a $54 move. And it stayed there for about 20 minutes before coming down $130 later in that trading day. So if we're saying that we think that the average price, actually, I think I have, these are our quarterly projections for the next 2 years for gold prices. If we're saying that we think that the price will average more than $2,000 an ounce next year, that speaks to a much higher intraday high during that time. And then you can see we have gold prices rising even further in 2025. This is based on a combination of our macroeconomic expectations economically, politically, issues in the world, and financial market stability. I won't bore you with all the details, but as hostile as the world has been over the last 5 years and 20 years, we think it's going to enter another round of extreme hostility, similar to what we saw back in 2007, 2009. Perhaps not as severe of a recession, but significant economic issues, financial market instability, and very importantly, this time around, a lot of political factors driving investors to want to buy more gold and silver because of political instability domestically within various countries and internationally. And I don't think I have to go through the extensive litany of issues that the world's facing at this point. But this is our economic view. We have the price rising sharply over the next couple of years. And then if you look forward beyond that, we have the price coming down, partly because that's what happens. We don't think that these economic and political issues will be resolved or solved, but there will be some backing off, we think, over time. If you look at the period prior to 2000, you can see there were periods of economic and political problems that lasted 1 or 2 years. Investors would pour into gold. They would drive the price higher. Things would get better, not necessarily solved, but better. And investors would buy less gold and the price would decline. After 2000, 2002, we saw a cyclical upward shift in the investment demand curve. More investors in more parts of the world and more types of investors were buying more gold for a longer period of time at higher prices. And they were doing that because there was this continual set of economic and political problems that were plaguing the world and causing investors to say, I should have more of my wealth in gold and silver. That peaked in 2011, and we entered a period when the price came down, came down to $1,200, $1,300, as I said. Over in 2020, you saw the big blue bar. You saw investors buy collectively or on a net basis about 40 million ounces of physical gold. And the gold price, as I said, rose to a record price. It went from $1,200 in early 2019 to about $2,000 at its peak in 2020. In 2021, 22, 23, investors have been buying 25, 26, 27 million ounces. That's enough to have kept the gold price up at these record levels and set new records, but it's not enough to drive the kind of sharp spike in increases in prices that we saw in 2019, 2020. Our expectation is that in 2024, 2025, you may well see investors buying 30 million ounces or more, and that should be enough to support the kinds of price increases that I just reviewed. It's really investment demand, and investment demand is flavored by a variety of issues. Interest rates are important. Dollar's important. Currency markets are more important than the dollar. Gold doesn't trade against the dollar. It trades against currencies. If there's a currency of choice, investors will tend to go in that direction. There is concern on many quarters right now that the dollar is overvalued. CPM Group doesn't necessarily agree with that. We over the last couple of years, as the dollar rose from over the last several years, and people were saying the dollar's overvalued, it's going to fall 5%, 10%, or it's going to collapse. We were saying, no, the dollar is going to rise, and that's because of the dollar's stature in the international currency regime and the lack of suitable alternatives. For the dollar to fall, it's not that we're bullish on the dollar. We're less bearish on the U.S. economy than we are on other parts of the world. For the dollar to fall significantly, investors have to say, I'm more bullish on Europe and Japan than the United States. Those are the major countries that have some liquidity in their currencies compared to other currencies. but it's far less than the United States. The United States has currency hegemonic powers because 60% of foreign exchange reserves held by central banks are in US dollars, and 70 to 80% of financial assets held worldwide are in US dollars. And the liquidity of other currencies is simply not there to really compete with the dollar at this time or over the last several decades. So our expectation is that what we'll see over the next couple of years is the dollar probably will rise further, as well as gold prices. And that's not unusual. You can see on this chart, there are times when gold and the dollar actually both rise together. They are considered the biggest risk heads / safe haven / portfolio diversifiers. People worry about federal debt. We've got $32 trillion worth of debt, and it's up to 120% of US GDP, which is where it was in 1946, by the way. And we paid it down to about 20% by 1980. But the reality is that if you look at global GDP and global debt from all sources, not just sovereign debt, but also corporate and private debt, you have total debt in 3 times global GDP. And most of that, all of that, has a higher risk premium than do US Treasuries. So when things get bad, if things get bad, and they will get bad, people will run toward the treasuries, toward the dollar, and toward gold as the protection. So there are a lot of people who say, well, the treasury, is in trouble and the interest rates have to spike higher, and no one wants to buy treasuries, even though there are record volumes of treasuries held by investors around the world. And it's actually been rising over the course of this year. None of that actually is true. What happens is you will have investors looking to protect themselves by going to the most liquid currency, the US dollar, the least risky financial asset, US Treasuries, and gold, which has no liability. No one has gold as a liability. So our expectation is that gold and the dollar will rise. Interest rates have risen on a nominal basis from 25 basis points to 5.25%. At 5.25%, nominal rates are at the low end of the range that we've seen since the 1960s through 2008. So interest rates have risen, but they're still very low levels. And we've seen that in real GDP in the United States. Even though rates have risen 5% over the last year and a half, they are still not so high as to turn off real economic activity. If you look at it on an inflation-adjusted basis, you now have real inflation-adjusted short-term U.S. Treasury rates of about 2%. 3% seems to be the point at which investors start saying, hey, why am I taking the risks inherent in owning gold? I can lock in 3% on U.S. Treasuries. I don't think we'll get to 3% for some period of time. Our projections for nominal interest rates and inflation suggest to us that actually the real rate will probably decline closer to 1 to 1.7% over the course of the next year, which will keep real rates low enough that they will not turn off investors from investing in gold. If you look at the factors that drive gold, interest rates, currency rates, stock markets, relative competing assets, safe haven buying, political risks, and gold as a commodity. And then there are people who buy gold as a form of savings, which sort of transcends those more economic factors. I will find investors who say, I'm not really an investor in gold or silver. I use those as a store of wealth, more as a denominator than a numerator for my portfolio. So we see a lot of factors probably stimulating higher investment demand over the next couple of years, and thus record prices. At the same time, you're also seeing increased demand for gold from central banks. Now, there were some bad numbers last year about 20 million ounces of central bank gold sales. It was closer to 10 million ounces. Year to date through October, central banks have bought about 11 million ounces this year, probably a little over 11 million ounces. The data for most countries through October is available via the IMF. The Central Bank, People's Bank of China, has not yet delivered its financial figures to the IMF, but they probably bought on the order of 20 tons, another 600,000 ounces, which would probably take through October total central bank gold purchases around 11 million ounces. You can see that on average, central banks as a group have been buying about 10 million ounces on average. It's ranged from about 6 million ounces in some years to about 17 million ounces in other years since 2008. And our expectation is that it will rise somewhat over the next couple of years, possibly to 12 or 13 or 14 million ounces over the next couple of years per year. But that you have to understand that central banks are much more price sensitive than investors. So if you look at this, and you can see there was a period where central banks are buying 16 million ounces. That was a period around 2017-18 when investors were buying far less. Let's see if I can go back there. Investors were buying less gold. The price came down to 1,200, and central banks said, I wasn't a buyer at 16 or 17 or 1,800, but at 1,200 or 1,300, I'm a buyer. And if you look at the People's Bank of China, they were buying a lot of gold in that period of lower prices. They were buying gold into the first half of 2019 when the gold price went over 1,350 and went quickly to around, I have all these prices here. You know, the price went from 1,300 up to 1,500 in the second half of 2019. The People's Bank of China stopped buying. They started buying again last November from domestic supplies, and they have been buying domestic supplies ever since. So our expectation is that central banks want to buy more and will buy more, but they are more price sensitive than investors are, private investors. So if private investors are buying 30 million ounces, they will in essence be outbidding the central banks. The central banks will say, I'm not going to pay 2,000 or 2,100 or higher for gold. I'm going to wait for it to come back. At least that's what they have tended to do historically. So that will be something of a break over the next couple of years if we do see the investment demand that we expect, and we do see the gold prices that we expect. But central banks are clearly accumulating gold. They want to diversify their portfolio. The red stuff is obviously net sales, and it's been very small since 2008, 2009. The yellow stuff is gross sales. Gross purchases are in yellow, and the green line is the net level. And again, you know, it looks like it's going to be about 13 million ounces or higher this year. As I said, 60% of foreign exchange reserves held by central banks are in the dollar. And if you look at central banks, these are developing economy central banks, and the red dots, if you can see them, are the percentage of monetary reserves in gold, and the bars are the amount of gold. Russia has a lot of gold. It's purchased a lot of gold over the last 10, 15 years, and that represents about 20% of its reserves. And it also represents a much higher percentage of its monetary reserves that it has access to, because of the other reserves, much of it, it's several $100 billion dollars, is frozen since it invaded Ukraine. But they have about 20%, more than 20% of their monetary reserves in gold. China is the second largest, but if you look, it's about 3% of their reserves. They're not looking to replace the dollar or buy enormous volumes of gold. They're looking to add to their gold as well as other currencies to diversify their monetary reserves away from this heavy exposure to gold. And that's for a couple reasons, one of which is that the dollar price is very high. So we've seen Poland buying gold over the last year or two, and there are several reasons for that. One is that Russia has invaded Ukraine. And in the early days of the invasion, when Poland complained about that, Putin pointed out to the president of Poland that large chunks of Poland used to be parts of Russia too. So there's a political risk and a military risk there. There are domestic political divisions which are causing problems economically within Poland, which is leading the central bank to add more gold to its reserves. Poland is at loggerheads with the European Union over some of its domestic policies that don't jive with the EU's directives as to how members are supposed to behave toward their people. And the dollar is their major foreign exchange reserve. And the dollar is high. And there are any number of people who keep saying, well, the dollar has to fall. It's too high. It's overbought. It's got to fall. So the Polish central bank, like many other central banks, are saying, well, okay, let's take some of our overbought, too high of a price dollar and buy other assets, other currencies, which for Poland would be not the ruble. No one holds rubles in their monetary reserves. Yuan is very low. They can't hold the euro because they're part of the euro system. So it'd be Swiss francs, yen, pound sterling. So our gold. So you're seeing that kind of mix. But if you look at those red dots, with the exception of a few countries like Kazakhstan, Uzbekistan, Venezuela, you find that most central banks have less than 20% of their monetary reserves in gold. So important, but relatively small portion of their monetary reserves. And that is likely to be reflected in continued demand. Terry asked me to speak a little bit about costs, very, very briefly, because I think I've already gone way too long on gold. The green line is the gold price. The all-in sustaining prices, costs by and large follow price. When the price was falling from 2012 to 2019, costs were declining, mostly on the sustaining cost basis because those are easily cut. The cash costs, labor, and raw materials needed for it are kind of out of the control of management as to being able to cut those costs quickly. But you can cut your overhead, your G&A, your exploration budget, and your development capital costs. And so you see the sustaining costs coming down as the price comes down. As the price started rising, you could see those sustaining costs starting to rise again. And you can see cash costs also starting to rise as labor says, hey, you guys are making your guys are selling your gold for record levels. Give us some. And total cash costs are now higher than they were in 2012. Those are trends that are probably going to continue for at least the next couple of years. Also asked me to talk about growth. I believe Terry has more if he gets a chance to talk. These are the estimated gross additions to gold mine production capacity annually since 2011. And again, the increases in capacity follow prices. And as gold prices rose from 2002 to 2011, 2012, you saw an enormous amount. Here's the longer view. You saw an enormous amount of money. The blue bars are the amount dedicated to gold exploration, and the gray parts are other hard rock metal exploration. And you can see as the gold price rose, exploration dollars went. As the gold price fell, they cut back, and now they're starting to rise again. That gets reflected with a long lag in actual capacity coming on stream. It peaked in 2013 in response to that long period of rising gold prices and some exploration success. Since that time, it's declined, and it's gone to very low levels. At some point, the current high period of high prices probably will be reflected in increased capacity coming on stream again. But there's a long lag, and it's probably worse now than it was 15 years ago because of a number of resource nationalism issues, ESG issues, stretched out longer permitting processes, and a variety of other issues, including capital constraints, that will probably slow the exploration and development response to higher gold prices. But we do believe it will come. Silver prices they reached a peak of $50 on an intraday basis in 1980, averaged about $20, I believe, on an annual average basis. They reached a intraday peak. These are monthly prices, so you don't see the $50. April of 2011, and came back down. They've risen up to about $33 in recent years, and they're trading around $24 right now. Our expectation is that over the course of the first 3 quarters of next year, the prices, silver is probably going to tread water, move sideways in a range of, say, $23 to $28. But then as we think the economic and political environment will be growing more hostile for investments, traditional investments, in the fourth quarter, we think that you'll see a wave of investment demand, which will start to push silver prices higher, possibly back up toward $30 on a quarterly average basis by late 2025. We have silver prices rising further in 2026 and then coming back down, not back to the $14, $15, $16 that we saw from 2014 to 2019, 20, but possibly coming back down to a level of, say, $20 to $25 an ounce in the latter part of this decade. It's all about investment demand. In contrast to the gold price chart, gold chart that I showed you, you can see there are long periods of time, like 15 years between 1990 and 2005, when investors are net sellers of silver. When investors are bearish on gold, they buy less gold. When investors are bearish on silver, they sell it. And then they come back and they drive the price higher. We were concerned because we saw this steep decline in 2017, 2018, 2019 in the amount of physical silver investors were buying. It picked up in 2020, grew a little bit further in 2021, came off with a thud last year, and the price of silver was reflected that. Our expectation or estimate is it's about 80 million ounces. You will see some numbers that are sharply higher than this by promotional groups, people who promote silver investment demand. Those numbers are just like crazy stuff. And there's some really bad data errors. We're actually speaking to some of those guys saying, you had some really bad data errors here. We don't necessarily want to criticize you in public, but we have investor clients who are saying, yeah, you have 80 million ounces of net investment demand this year. Other people are saying, record 300 million ounces. And we say, well, if it's record 300 million ounces, why is the price of silver $24.50 right now? Yeah. I think one of the best pieces of evidence there. Modest declines. This is our estimates of total silver production, both scrap and mine production. The blue part is mine production. We have it declining modestly over the next 10 years. And we have scrap actually coming down a little bit more forcefully in the second part of the next 10 years, reflecting that downward slope in secondary recovery. There's a lot of silver in the ground. These are USGS data for reserve base. We have 16 billion ounces of reserves that the USGS keeps track of. That's more than double what we had in the 1980s, even though we have mined 26 billion ounces of silver in the interim. There's plenty of silver in the ground to be mined, and this doesn't include the stuff in Eastern Russia and China. And there's about 5.5 billion ounces of silver in above ground refined bullion bars and coins. The green part are coins, which have become one of the preferred methods of holding physical silver on the part of investors. The gray part at the bottom are ETFs and exchange traded products, which has some favor on the part of investors. And the blue part are unreported metal, a couple billion ounces, maybe 1 billion ounces of which is owned by banks and trading companies and leased out on a rolling basis to miners, refiners, smelters, fabricators, wholesalers, and retailers of silver-bearing products. Most companies that use gold and silver and other metals in their products actually lease the metal in during the production basis. That frees up capital for other applications, and it gives them a perfect price hedge because they'll pay a interest rate while they're holding the silver and making it into their products. As they sell their products, they will buy the silver or gold contained in those products and then top off their leased in inventories. So they'll use the same day's price. They will literally call their bank and say, I have 1,000 ounces of silver that I'm shipping in electronic products or jewelry products today. What's your price? And they will get a price and they'll say, okay, the price at which we're buying from you is this, and the price at which we're selling our products, silver content of our products, is this plus a certain percentage, which reflects not only the financing costs of borrowing that metal during the leasing process, but also manufacturing and profit. So you have a lot of silver and gold that's held by banks and trading companies, that's owned by them and leased out to their clients on an ongoing basis. So there's plenty of silver above ground, and there's plenty of silver below ground. The silver market's not running out of metal. Fabrication demand has basically been flat in total over the last 25 years, but there's been big shifts. Photography went away. Jewelry contracted for a weird period, but then it started to expand again, but now it's starting to contract again. Electronics and silver use in other things have come along, and solar has risen sharply. There's a lot of over-enthusiasm and unrealistic estimates about solar. These are the amounts of thick film solar panels that were produced over the last 20 years, 22 years, and CPM Group's projections over the next 10 years. You can see a very dynamic growth in the solar panel production that and that gets interpreted into silver use, which we also have rising very sharply, not as sharply as production, because there will be some per unit sales, reductions in per unit use of silver, if we're right and the price of silver rises. So we're looking at silver use in solar panels taking close to 20% of the market by 2032. There are people who will assure you that the use of silver will be 500 million ounces next year, and that it will be using 50% of silver supply. It's just not going to happen. It's an unrealistic projection. And as I point out in the title of one of these are the solar PV panel manufacturing industry projections, not silver promoters. Platinum, almost, I think it probably are way out of time. Platinum prices and palladium prices, we just completed our update of our long-term supply demand price outlook for platinum, palladium, and rhodium. Last week, we 95-page report, and basically we're looking at three metals that are losing market share. You know, automotive catalytic converters account for about 50% of platinum, 60% of palladium, and maybe 90% of rhodium use. They're losing market share to electric vehicles, which don't use catalytic converters, don't use PGMs. And we are skeptical that fuel cells will be a form of on-road motive propulsion technology. And even if they are, most fuel cell manufacturers have engineered the platinum either to a de minimis amount or completely out of their technology. So, 5 years ago, Toyota and Volkswagen said to the catalyst, to the fuel cell manufacturers, we want to have like maybe 30,000 vehicles, fuel cell vehicles on the road as demonstrations and test units by 2023. But we need you to cut the platinum use in half for cost reasons. And the fuel cell manufacturers universally said, we can get rid of it completely. So we don't see fuel cells as a saver. We don't see the PGM markets. We don't see electrolyzers as savers. The International Energy Agency doesn't see electrolysis of water to produce hydrogen as being a major industry, at least through 2040. The capital is not being spent on it. You have 6 to 10 companies that are spending money on electrodes to supply that industry, but you don't have 6 to 10 companies worldwide that are saying we're going to spend a lot of money building electrolytic refineries to produce hydrogen from water. So that market is going to be much slower to develop. In addition to that, the platinum catalyst electrodes that the South African platinum industry talks about compete with stainless steel and titanium plated steel electrodes. And the cost differential is in the thousands of percents. So the efficacy of spending the money to use platinum or palladium or iridium in those catalysts, in those electrodes, isn't there. So the good news is don't worry about it because the electrolysis industry isn't coming along, at least in the next couple decades. The bad news is even when it does, if it does come along, it's probably not going to use PGMs. You put all that together, declining market share. Well, there's another factor that I'll show you. Declining auto market, declining share of the auto market that uses petroleum products and thus PGMs in catalytic converters, the lack of those big new markets that are going to save this industry. And you see platinum and palladium and rhodium prices probably declining. And we take our projections for these metals in that report I mentioned out to 2050. And there'll be periods of time when the price will rise. But overall, we expect the prices of all three metals to be relatively weak for the next quarter of a century. You will see lower fabrication demand. You'll also see lower supply because the South African industry will not be profitable enough and will not be capable of attracting the capital needed to put in newer, lower cost production. So you're going to have a race downward in supply and demand. There'll be periods of time when supply probably declines faster than demand, and the prices of these metals can spike up, especially palladium, but also to some extent platinum. But overall, we have a bearish outlook for platinum, palladium, and rhodium prices for the next quarter of a century. This is how the platinum price has been since 2013. And our expectations for the next couple of years are basically flat prices around $1,000 an ounce on a quarterly average basis. Again, promoters will talk about these massive deficits of platinum. They do that by including their estimates of investment demand in with fabrication demand. When we look at a supply-demand balance, we look at total supply, including scrap, less fabrication demand. If somebody is buying platinum but holding it as platinum in bullion form that's readily resaleable, that's an investment unless it's for working inventories. And we don't include that in our supply-demand balance. We want to know if a market is in a fundamental deficit or surplus. And you can see for most of the last 50 years, the platinum market has been in a surplus. The surplus fell sharply this year, which helped the platinum price rise in the first quarter, but then the platinum price fell back, and the market seems to be relatively well supplied. These are our projections of the auto industry and the composition of motor propulsion technologies. The blue stuff at the bottom are gasoline-powered vehicles. The next part up, well, diesels are actually the orange stuff at the top. And you can see that out to 2050, we still have more than 50% of the vehicles either gasoline-powered or diesel-powered or hybrids, which use diesel or gasoline. So our expectation, which is in line with the main scenario that the IEA uses, is that 25 years from now, we will still be using PGMs to clean up emission standards for half of the vehicles. Now, the other question is, well, what's the auto market look? We have growing auto production through into the 2040s. And I apologize, this is a little bit out of date. We revised this so we're a little bit more pessimistic about the total number of vehicles being sold over the next quarter century. We do have peak auto within 20 years. Other people think that peak auto production and sales occurred in 2017. Other people think that it's probably going to occur within the next 5 years. We're more optimistic about the number of vehicles that will be being produced and sold based on the view that while Europe is a shrinking market and Japan is a shrinking market and the United States is a plateauing market, the vast portion of the population of the world are outside of those countries and regions and still want to buy more vehicles. So we have a more dynamic growth in the auto population going forward than others. Palladium prices rose very sharply. They've come down with a thud. Our expectation is that they move lower over the next 2 years and over the next 20 years, really. Although we do think that there is a possibility of a period of time where there's simply not enough palladium readily available, and you could see a significant pop on a short term, 2 to 5 year period at some point over the next decade, that you could see palladium prices rise at least briefly. But we think that the record palladium prices are behind us. We do have a surplus. It has come down after a couple very high years starting in 2020. And that's what I've got. So I guess we could open it up for questions. And I think there probably are a few. Thank you for listening to me.
Well, thank you very much, Jeffrey, for your presentation. As always, very informative. So if you've got questions, by all means, I encourage you to input your questions in the chat box, and I will read the questions on your behalf to Jeffrey. But I do have one question, okay? And it's based on in a news article that I recently read, basically saying that critical metals hype doesn't match reality in Canada or even globally. What's your view on that?
We have been, it's funny because so many people, they think in terms of black and white. And until maybe a decade ago, I used to give speeches where I said, the world is really, I still use the term that, you have to think in terms of shades of gray. We assume that electric vehicle market will grow for the next 20 years or so. Ultimately, we think that hydrogen engines replace electric vehicles as the alternate vehicle propulsion technology of the future, but that's decades away. We have electric vehicles growing, but there has been a tremendous amount of hype and over enthusiasm for the energy metals transition. Now, if you go back to solar power, that is an industry that's here, and solar power is cost competitive and it's fully financed. And I know in the United States, it's a significant part of our electricity generation. I was doing some work on uranium this past week. 5% of power generation in the United States was small, homes and factories, non-utility level solar power, and utility level solar power was even larger. That's there. Wind power has a lot of headwinds. excuse the pun, if it is. I don't mean it as a pun, but there are NIMBY issues. People complain they don't want solar, windmills in their area. There are also constraints on supply. You need a lot of high tensile steel, which means you need a lot of molybdenum. And you also have the issue of magnets. We've been looking at iron nitride battery magnets, which could replace rare earth magnets. They're a fraction of the cost. The raw materials are scrap iron and nitrogen from the atmosphere. There's a sustainability of the magnetism, which is being worked on, but you have several major auto companies and other companies looking at iron nitride magnets as a replacement for rare earth magnets. And we think that that's going to be there, which will take all of that money that's being invested in exploring for and pre-development work in rare earth mines and flush it down the toilet. In terms of cobalt, 5 years ago, people assumed, not CPM Group, 5 years ago, we were saying that cobalt would be engineered out of lithium ion batteries. Don't invest in long dated cobalt exploration and development companies. Other people were saying, no, 30% of the cathode, active cathode material will be cobalt sulfate, and you're going to need all this stuff. Then the battery industry said, no, it's going to be, we're lowering it to 20%. So you lost a third of future cobalt demand. Then they said it's going to 10%. So now you've lost 2/3 of future cobalt demand. And now there are any number of battery and automotive manufacturers say, we can get rid of the cobalt. So there's been a lot of money that will have been lost, if not already lost there. So we think there's a lot of over enthusiasm there. And then when you look at the electric vehicle market, as I said, there are people who think that we will be at 50% of the auto market in vehicles by 2030 and 100% by 2035. We have it at 50% or less by 2050. So the transition for electric vehicles will be much more hesitant. There are political and social issues. There are capital issues. There's raw material issues. There's technological issues. You start saying, well, we need you to build a motor. Last year we built 13 million motors for electric vehicles. We need you to build 90 million or 100 million. We need you to build the factories to build them, but we're not going to give you orders because the technology is going to change or could change. And so we're not going to commit to buying these motors. We just want you to find the capital to build these factories to make motors that we may never buy. Mm-hmm. Yeah. And that technological uncertainty then leads to a paucity of capital investment. And that's going to be a major headwind for electric vehicles for the next time. And then you have the whole issue of where you're getting your electricity. 50% from coal-generated plants, another 30% from natural gas plants. And there's a growing understanding on the part of consumers, at least outside of China, that you're not reducing carbon dioxide emissions, at least for the next 10, 20, 30 years, by switching to electric vehicles. So you're paying extra money. Then there's the whole issue of battery replacement. 10-year average purchase life of a vehicle, and the batteries are warranted for 5 years. You get $7,500 in the United States if you buy a U.S. intense electric vehicle as a tax rebate. But when you need to replace that $10,000 battery pack, the government's not there to help you with the cost. So there's a lot of commercial, social acceptance, as well as capital and technological uncertainties that are going to slow the growth of electric vehicles. And lithium promoters and cobalt promoters and rare earth promoters have all been too enthusiastic for too long.
Okay, so that leads me to my next question. Okay, and how would you invest in critical metals? Because I'm sure there's a lot of people in the audience that is thinking that same question and are reluctant to ask. So I'm going to ask on their behalf.
I don't think we put our address here, so I don't have to worry about getting beat to death on the way home. But yeah, I like to save my clients money by keeping them from making bad investments. I happen to like high purity manganese. It's not so much manganese mining as processing manganese into high purity manganese sulfate. That's the thing that's replacing the cobalt sulfate. I happen to like molybdenum because it is used in drill pipe for oil and gas, and it's used in transmission pipe for oil and gas, and it's used in the towers for wind, and it's used in other environmental and infrastructure expenditures. So I think that molybdenum and manganese are probably the two highest metals that we like. We like things like niobium, but it's a very small specialized market. Tantalum, the same sort of thing. Tantalum is not so much an energy metal. It's a critical metal used in semiconductors. And so we like those kinds of specialty metals. But the way to approach it is to do your homework. I did a weekly CPM group video yesterday, and in it, I started by saying I was fascinated by this meme that's going around that American males think about ancient Rome several times a day. And I thought, okay, I know that I'm not a typical American male. I've been told that since grade school, repeatedly, usually by guys with their hands and fists formation. But I don't think about ancient Rome. And when I do think about it, I think about what bastards they were compared to the Greeks or the Etruscans. But that's beside the point. I said, where did that come from? And what are the numbers? What's the research behind it? So when I had this head cold over the US Thanksgiving weekend, I went online and I said, where'd that come from? And there was this Dutch influencer who, off of the top of his head, posted something that said American males are always thinking about ancient Rome. No research, nothing to substantiate it. It was like poof, out of his head like Athena from the head of Zeus, fully clothed and armed, nothing to support it. It was some, I can't think of a word to use that would be appropriate. It was there was nothing behind that. But yet you're seeing that view, that opinion held worldwide. And that's a real issue. It's indicative of the gullibility of people across the social issues, from politics to society to, hey, which metal should I invest in? You've got to do your research, and you've got to rely on good research. I mean, when a guy is in the business of marketing precious metals to investors, he's not a research person. He's selling precious metals. CPM Group sells research. We don't sell precious metals. We sometimes buy them and sell them for our clients, but we're in the business of trying to keep our investor clients and our mining clients from losing money and helping them make money. And you've got to say, well, where does data come from? Everybody's telling me that I should be investing in rare earths. Well, who's everybody? And it's frightening. I mean, if it's a frightening way that the world works.
And so I got a follow-up question with regards to this. And again, like I said a couple minutes ago, if you've got questions for Jeffrey, by all means, I encourage you to post your questions, and I'm happy to read them on your behalf. How would government play? How should government play in the context of the new? Because you talked about a lot of constraints when it came to the critical metals and the uncertainty of everything in terms of you're asking suppliers to produce, but you're not guaranteeing them the actual purchase of all these platforms. So how would you advise government what role would you advise government to play in this whole thing?
Okay, before I answer that, let me just add to your comment about the questions. I would ask you, if there are questions that we don't get covered, send them to me and I will respond either to you, and you can post them on your website if that's possible, or I'll send them to the person who asked the question.
Sure. Can you, do you mind if I share your email address with them?
My email address is jchristian@cpmgroup.com. jchristian@cpmgroup.com.
Okay.
And there's also info@cpmgroup.com.
Okay, wonderful.
in terms of governments, I think the government should be encouraging private investment in assets. They should not be in their way. But like, for example, in the United States, you have people who are looking at a closed rare earths mine in California that doesn't make economic sense. And they know it doesn't make economic sense. So their reaction is to go to the federal government and beg for hundreds of millions of dollars that will be wasted if that project ever goes into production. Similarly with lithium. I mean, if you look at the lithium market, there is a lot of lithium, and SQM and other brine manufacturers in South America have such a cost advantage, and they can ramp up production and take out any hard rock mining that might come along, unless that hard rock mining has significant tantalum or niobium or other metals that you can retrieve to make the whole thing worthwhile. So then you add in the fact that if you've got 30 million electric vehicles and you have untold number of electricity storage systems that are using lithium ion batteries, and those lithium ion batteries have 5 to 10 year useful lives, you're going to have a mountain of lithium that can be recycled and reused. And the battery manufacturers have avoided that for now, but they're starting to say, no, we can and will use recycled lithium. When you plug in the potential flow of recyclable and lithium from spent batteries, you don't need those hard rock mines. And so the idea of despoiling, sacred burial grounds in Nevada and arguing over it, the idea of arguing over such a stupid thing is incredible. Let alone the idea that you might say, no, we're going to rape and pillage this land, regardless of its sacredness, to get at lithium that we never will need. So I think that governments need to be very cautious, and they shouldn't be spending, you watch the news and the government says, we're going to spend $100 million to rejuvenate this mine. It's like, well, where are you going to get it? Because you don't have it. I mean, you're $32 billion in debt, $1 trillion in debt. You don't have $100 billion to flush down the toilet in Northern California. Spend your money. We've had institutional investors say, we're thinking of putting $400 million or $40 million into this mining project on vanadium. And we would like a report from you guys and advisory services from CPM Group. Is vanadium something we should be investing in? And is this property something that we should be investing in? We've got a $40 million price tag that we're looking at. We say, yeah, okay, our vanadium project, research report, 10-year projections, consulting services to support it, that's a $50,000, $60,000 deal. Okay, we're not going to do that. So, okay, you won't spend $50,000 to confirm that a $40 million investment makes sense. I go, right. If we invest in $40 million and this thing goes south, hey, it was a bad investment. If we spend $50,000, a fraction of that, on a research report that says we were stupid to think about vanadium, we're fired. And in fact, that's happened. We've had some of the largest hedge funds and private equity firms in the world, buy titanium reports, tungsten reports. There was that whole big gobbledygook. There was a marketing hype with the super cycle on commodities. And in 2006, 2007, we were selling reports. Don't buy this tungsten mine. Don't invest in this titanium mine. Don't invest in this vanadium mine. And we had a client, one of the largest private equity shops in the world, who bought several $100,000 worth of our research. And over the course of 2 years leading up to the Great Recession, did not invest in a number of mines. And we thought that was great. He thought it was great. And his boss fired him because his job was to invest in mining, and he wasn't investing in mining. Yeah, that's a stupid way of living, but you might as well just sit around and think about ancient Rome.
Okay. Note to myself. How's that? Okay, so we got a question. Actually, we got a few questions. That's great. One question is, any comments on the fact that Canada has no gold reserves?
You mean monetary reserves?
Yes.
Uh, we watched the Royal Canadian Treasury sell its gold off over the years, and we thought that they were a little bit excessive in that. Our advice had been that they should retain some portion of their monetary reserves in gold. But they, like Australia, made a decision to get rid of it. Now, Australia has started to rebuild its reserves, interestingly enough. But Canada hasn't. I think that any prudent monetary authority should have some small but significant portion of its monetary reserves in gold, including Canada.
Okay. So next question, how does Jeffrey see gold production cost structure evolving over the next few years in terms of inflation getting locked in?
We see I think I mentioned it earlier, our expectation is that the cost structure will continue to rise. Let's see if that works. Yeah, no, it doesn't work. Our expectation is that the cost structure will continue to rise. Part of it is that you've had this like 2-year period of high inflation that is being baked into costs. We do see inflation coming down. We don't necessarily think it gets to 2% anytime soon in the United States or Canada. So we do think they're going to be continuing to be inflationary pressures, both across, sustaining as well as operating cash costs. And that is probably going to continue to push all-in sustaining costs to higher record levels.
Okay, great. Another question. Why are gold companies suffering from getting financing and in brackets almost crisis levels, yet gold prices are at or near all-time highs?
I think there's several factors. We did a study several years ago about institutional investor interest in Canadian listed mining companies, not just gold, but across the mining industry. And we found several things that are going on the institutional level. And, let's say we had 5 factors then, 2019, and then 6 factors. And now there's a 7th factor. And that 7th factor is that everything has gotten more expensive and more difficult to move forward. But of the 6 factors, only one of them had to do with mining. And that was underperformance of the mining companies on a financial basis. And it reflected a variety of issues within the mining industry that they could deal with. But the major factors, the other 5 factors, had nothing to do with mining and everything to do with institutional investment markets and industry and changes in that industry, both the buy side institutions and the sell side supplying them. And there were cost pressures, there were performance pressures, there was the fact that investors were shifting to indexed fund investments rather than individual mining companies or individual corporations in any industry, and that those indices were providing better returns, and B, beating the returns most years of human managed investment funds. So you started seeing the buy side companies. I mean, BlackRock said, we'd love to get rid of our analysts. We'd love to get rid of our investment managers. We'd love to just have a room full of computers running this thing. And those computers wouldn't necessarily look at individual companies. So you have a shift away from providing, you have a divorce between capital formation for companies and equity markets. And that and other factors related to the buy side and the sell side industries are things that the mining industry can't really resolve. I mean, this is beyond their purview. So that's a real problem that persists. Underperformance as corporations for a variety of reasons. The big companies have underperformed for a variety of reasons. They keep chasing the number of ounces and reserves and overpaying for their competitors to buy replacement reserves. On the other end of the spectrum, you have small companies that are, I think you guys call them lifestyle companies in Canada that have been collecting money and living off of investment fundraising for decades without moving properties forward. And you have some really good companies that are caught up in that, unfortunately. And they say, no, we're legitimate and we're actually buying properties or buying options on properties and moving them forward. And they're finding it difficult to find that capital because of all of these other problems with other companies in the industry. And I don't see that changing.
Okay. And one last question, because I know that Terry has a few questions in his bag to ask you. So, okay. So do you have any comment on CIM?
On what?
CIM.
Cesium.
Cesium, sorry, Cesium.
That's used actually in fusion reactors.
Yeah.
Oh,
specifically.
cesium. Yeah.
Yeah. Sorry, forgive my accent.
No, forgive my deafness. Comes with age. Yeah, I have a cartoon which I don't dare show my wife, and it's a guy coming home saying, "The doctor says my hearing's fine. You need to stop mumbling." But I don't dare show that to my wife. I like nuclear power, and unfortunately, I look at the IEA data and I look at the nuclear power industry, and it is flatlining. There is a lot of technology that people are unaware of. In the United States, nuclear power plants, we've built one nuclear power plant since 1980. Our amount of electricity that we generate from nuclear power has risen more than 200% in that period of time, from reactors that ostensibly were at the end of their useful life in the 70s and 80s and 90s. But they've been retrofitted with better, newer technology. And the public is totally unaware of that. So I like nuclear power, but I don't see how we get over that public stigma. It looked like we were going to until 2008, 2009. And Fukushima changed all of that. I do think there is stuff. Now, cesium, interesting. Some of the other metals involved, interesting. But while we like nuclear power, our view is that you don't need uranium mines, because what you need to do is get rid of those 1970, I think it was 76, 77, restrictions on reprocessing spent fuel. You have this massive spent fuel problem around the world, except in France and China and Russia and other countries where you can reprocess that and reuse it. Those laws were put in place in the United States not because they were worried about nuclear proliferation. That was the stated cause. They were put in place because the uranium mining industry out west said, hey, if you allow this reprocessing to really take off, we can't profitably mine. So you get rid of those laws and you start saying, let's be rational in our approach to nuclear power. You don't need uranium. Cesium, it's a different story. I don't really follow it that closely, but it's part of what I understand as the solution to making nuclear power safer and more economic.
So, Terry, feel free to take over with your questions.
Thanks, Carlos. Thanks for running the show while I'm catching up here.
Welcome home.
Finally, yes. Jeff, I attended a couple of conferences, but I'd like to get your views about a lot of the questions that are asked to me as well, which I had partial answers, and you are far more advanced in those topics. World Gold Council and I think the market itself promoted jewelry as the way to solve the issue of the central banks selling over the years. Okay, and jewelry became almost like 70% at one point in time of the demand. Here's the questions coming from the people actually really on the line, manufacturing, producing, and selling jewelry. Yeah. Question one to me was, should they do any more jewelry less than 14 carats? And less than 14K, they should be not stamped, period. Okay. And above 14 carats, the standard should be subjectively advertised that the World Gold Council and the jewelry industry around the world wouldn't like to see less than 18K. Okay, these are profound statements by the people that are interested in turning the gold into jewelry and people to buy for the surety of the investment, the asset value, because we always argued about that. Don't buy gold, buy jewelry. Now it's came to the point whereby, we got Walmarts and whatever selling for 8, 10 carats jewelry, and which is like a major volume. But 14K should be minimum, 18K advertised. Would you actually agree with that statement and support it? Thank you.
I don't agree with it, and I wouldn't support it, and I haven't supported it over the last 25 years when it's been a topic. And you touched on it right there. You look at gold use in jewelry, and the vast amount, well, it varies from place to place. In the Middle East, in South Asia, in China, and Japan, the 24 karat gold jewelry was the norm. And the World Gold Council came in and said, we will give you advertising dollars for your jewelry, co-op advertising, which is very common in the jewelry industry, but you have to market 18 karat jewelry because we're trying to standardize jewelry worldwide at 18 karat. That destroyed or really damaged the most vibrant gold jewelry markets in the world. Then you go to Europe, the United States, Canada, other countries, and you find large amounts of gold being used in jewelry and being bought in jewelry. And the average price point back in the day, in the 80s and 90s, was $90 a piece. Now it's like $120 a piece or so. All right, you say, okay, wait a second. Gold is $2,000 an ounce, and you're selling gold necklaces at $100 a piece, or earrings. And that is not 18 karat or 14 karat jewelry. But the vast majority of gold that goes into jewelry in those countries, the richest countries in the world, is 8 karat UK, 10 karat, 12 karat, 14 karat plated, 18 karat plated. So I think that the idea of standardizing at 14 and 18 carats is a bad idea that has damaged the gold jewelry market and the gold jewelry industry. In addition to which, it's not where the volume has been. And I think that to come into a market where you have companies that are multi-generational producers of jewelry and say, hi, I used to work at McKinsey, but now I'm a gold expert for the last 3 months. And I'm telling you that you need to get rid of all of this volume. It's just a bad idea. It's a bad idea. And the gold producers, unfortunately, have never paid that attention. We got into this whole thing where we had to explain recycling of gold in the jewelry industry. And we talked about sputtering targets and how they're, when you take a 400-ounce sputtering target and you make jewelry or electronics out of it, 80% of that gets recycled and reused. 20% of it goes onto the product, or 30%, right? So you have this massive amount of metal. And we were explaining that because there were people in Canada who were saying that CPM Group and the World Gold Council grossly underestimate how much gold is being used, because they were measuring the amount of gold being taken off of the Shanghai Gold Exchange and saying, oh, well, all that gold's going into jewelry. But actually 70, 80% of it was being recycled over and over again through this process. And when we explained that, working with the Shanghai Gold Exchange and the People's Bank of China, and we explained that on a global basis, we were inundated with mining executives in Canada, the United States, South Africa, who said, what's a sputtering target? We had one executive in South Africa who said, yes, these are really fascinating things. I went to visit a jewelry manufacturer and I saw this. I was just flabbergasted by it. Now in China, if you want to be a mining executive, you've got to take all kinds of studies and tests, and you got to go to jewelry manufacturers and see how they use your product. But in the West, the mining industry doesn't even know how its product is used, or who's using it, or how what the recycling process is. So when the World Gold Council comes along and says, "Oh, we should standardize it all at 18 karat and not allow," who are you to not allow anyone to make less than 14 karat gold jewelry? There shouldn't be anything below 14 karat, and everything should be pushed at 18 karat. The mining industry doesn't know the market for its own products sufficiently to stand up and say, that's a bad idea.
Okay. Listen, I have two more questions, and we can wrap it up. I'd like the audience to hear these questions and hear your input. I appreciate that. I have my own views, but this is your forum. Here, BRIC countries, they've been accumulating gold. Okay, no question. So the question was, when the time comes, they will decide how much more gold representation gonna be in the BRIC currency. Okay, so the question is, a la USA, last time they valued the gold was 1971, right?
73,
and 73, yeah, and before the 1920s or to early 30s. So what would you recommend for BRIC countries to set the price of gold if the opportunity comes in, and they will decide they're going to do it per ounce?
Okay, this is kind of a dud question, because the answer is I would advise anyone not to set the price of gold. Yeah, and partly because
no. Set the price of gold for the currency as a backup currency.
Second thing, now the reason why it's a dud question is if you look at BRICS, Russia would like to have some gold related currency. China doesn't want it. South Africa doesn't want it. Brazil doesn't want it. India doesn't want it. So Putin, and even within Russia, there are people within the Russian central bank that don't want it, and they know it's bullshit and nonsense. But Putin wants it because he's anti-US and anti-dollar, et cetera, et cetera. So Putin has pushed this. China says, we don't want any relationship between gold and our currency. We definitely don't want any relationship between our currency and your currency, because you've got the ruble. And as I said earlier, no one holds rubles as monetary reserves. And India has the same posture. India has been rebuilding its gold reserves. The last thing it wants is for somebody to say, oh, pay for your imports of my oil with gold. It's like, no, I'm going to pay for it with euros and dollars. I'm going to pay your bank, and your bank can go into the market and buy rubles with those euros and dollars and pay you the rubles that you insist on using. We do not want to use our gold as payments for international trade. The Chinese say the exact same thing. The gold in China stays in China. Brazil and
South Africa,
Brazil and South Africa have like 3 million, 6 million ounces of gold. In the case of Brazil, that is about 2% of its foreign exchange monetary reserves. In the case of South Africa, it's about 11% or 12%, because South Africa has fewer currencies in its monetary reserves. It's in worse shape economically than Brazil. So they don't have a lot of gold to use in it anyway. So the whole idea, and there were all these gold promoters who were talking about how the BRICS conference in South Africa earlier this year was going to have a gold-backed currency announced. And that was Putin's doing, and these guys are sucking it from, Putin. China was saying, no, we don't want this. India was saying, we don't want this. Brazil, South Africa, they were saying, we don't want this. It was just Putin and Russia. And it makes no economic sense. Even the central bank of Russia knows it makes no economic sense. If you want to, if you look at this is 1967 and 68. These are people saying, hey, you say that the US dollar is worth $35 an ounce of gold. Here are my dollars, give me your gold. And in 1967, the US government coughed up more than 45 million ounces. This is net central banks. Some of that gold that the US Treasury coughed up in 1967 went to other central banks. But on a net basis, 45 million ounces was given to private individuals at $35 an ounce. Through March of 1968, it was like 22 million ounces. And somebody said, wait a second, that's 1/4 of the year. Multiply that by 4, that's 88 million ounces of gold that we would be coughing up this year. So in April of 1968, Lyndon Johnson closed the private sector gold window and said, private entities can no longer come to us at our gold window. There was literally a gold window, and say, here's our dollars, give us your gold. You can't do that anymore, right? That's what happens when a government is stupid enough to say, we're going to tie our currency to gold at a fixed price. And
Okay.
the US may be dumb enough to do it again, but I don't think the Indian, Chinese, South African, or Brazilian governments are that dumb. I think they actually know history better and say, yeah, that didn't work well for the US.
Okay. The convertibility is one part of the question. The convertibility has been eliminated since then. It will probably never going to happen in the world currency history or future again. But it's the symbolic price that they want to, they will ask, what will be the foreign exchange of BRIC countries versus US? US, if you do pure analysis, it's because of the demand of the currency. So the BRIC, if you put a number $100 or $500 or $800, it gives a different perspective, but not convertibility. That's what the question really was.
Yeah. A gold indexed currency without convertibility is like an open marriage. No, it doesn't work. It just doesn't work. It's the stupidest thing that you could think of, right? I mean, okay, now let's go back to actually one of the things that got me my job in 1980 was the Reagan campaign. Arthur Laffer, the notable economist from Southern California, close to the peyote fields, who came up with the Laffer curve and supply side economics and all those other things that didn't work. He wrote a plank for the Reagan platform that said, we will return to a gold standard. Now, this was only 8 years after Nixon had suspended convertibility on an official basis. And Laffer said, we have this thing, we will have a 40% cover, as we did before, and as other central banks have had under classic gold standards. We will have 40% gold cover for all treasury bills that we issue going forward. So I took him out drinking, and I said, so what's the game? And he said, we haven't issued a treasury bill since 1971. If you look in your wallet and you have US currency, it's all Federal Reserve notes. And we can print Federal Reserve notes till the cows come home, but people will support the dollar because we told them that we will have gold backing for the treasury notes. And no one will pay attention to the fact that we don't print treasury notes. So I wrote an article about that. And the next day, these guys who were negotiating hiring me called me up and said, let's have lunch and get you on board. Yeah. That is the level of duplicity and dishonesty that occurred in the Reagan campaign. And that was the last time that anybody raised the idea of a gold standard in the United States at that level.
Excellent. Jeff, you don't need any second job or third job or fourth job. You're really entrenched in your company. You're doing very well. You got a great audience. Thanks for doing it for us. Very elaborate, very detailed. Love to debate with you a lot of things and your industry norm. I came from Mines and Money. There's a lot of issues we can talk later. But Carlos, thank you for, besides your chairmanship of the CIM MES, doing this on behalf of all the audience. And I Am Gold, thank you for their support. Jeff, have a great year ahead. If I miss anybody and anything, Carlos, please.
This concludes our CIM discussion group series for 2023. I hope you've enjoyed it, and we'll definitely see you again in 2024. First, I want to thank Jeffrey for a wonderful presentation today. I also want to thank you for joining us today and hope to see you sometime again next year. If you are interested in getting notifications of upcoming events, right, do let us know. And how you're going to do that is you're going to actually, let me just share the screen. Bear with me for 2 seconds. You're going to go to our website, right, which is CIMMES.org, okay? You're going to go over here where it says stay connected, okay? You're going to send us an email and you're going to let us know that you wish to join our mailing list, and we'll definitely keep you abreast of upcoming events, okay? If you're interested in listening to the recording of this presentation, all you have to do is go here where it says national on the top over here. And then from here, you're going to go into highlights from past events. And in the next week or something along these lines, you're going to see it posted right here, the presentation. So keep an eye for it, and you'll have it. Unfortunately, it's going to be a limited time, so it's going to be here maybe for 2 weeks or something along those lines. But by all means, we encourage you to share the link with friends and colleagues. And yeah, so this concludes today's event. So I hope you've enjoyed it and hope to see you again next year in 2024. Thank you again and happy holiday season.